Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. Let's talk about the hot topic that everyone's talking about, Silicon Valley Bank. Now, Silicon Valley Bank and a lot of the regional banks have seen massive sell-offs, especially Silicon Valley Bank dropping more than 60%, some other regional banks also dropping 20, 30%, and the whole banking sector in negative territory and really selling off on these fears. And what fears? Well, the fears started with the Silicon Valley Bank talking about and mentioning that it has issue with liquidity with its cash balance. And so that started to spur a lot of issues. Peter Thiel came out and said that, hey, get your money out. There could be a big issue at this bank. Higher rates are affecting this bank. And then you've got the FDIC coming in, taking control now and trying to kind of put a lid on this flame and this explosion that's happening. Now, what has happened? What has caused this explosion or implosion to happen? And it goes back to 2021, when a lot of these companies, these banks, these pension funds, and it relates a lot to also the UK story, which I'll talk about a little bit later, but it relates to a lot of these companies out there going out and purchasing US treasuries. Now, these banks are not allowed to buy speculative products like stocks or commodities on their balance sheet as a substitute to balance things out within their balance sheet, right? They're told from the Federal Reserve that you have to keep the U.S. Treasuries on your balance sheet, and that's where a lot of these banks will go out and say, okay, accumulate these U.S. Treasuries. They're paying 1.7% or what have you during that time, and they'll hold them to maturity and keep that in their balance sheet. The problem is, this is where the problem comes in. The problem is that if you hold these assets and you have not hedged against interest rate risk, which happened in 2022 where interest rates increased aggressively, and you get this 25, 50, 75 basis point rate hikes non-stop, meeting after meeting, what happens is the value of your bonds start to decrease. The price starts to come down as these rates go up. So now you're holding these assets that are supposed to protect you and not be so volatile. But 2022, you saw bonds and stocks both sell off, and bonds aggressively because of these higher rates, which caused a lot of these banks to suffer, pension funds and so on, like in the UK, to suffer because of higher rates and the massive drop in their assets. So now their asset side on their balance sheet is starting to shrink, and they're having issues with cash and liquidity because of the shrinkage, and they haven't hedged that. They haven't protected the scenario of bond prices completely falling to record lows while the rates are going up, and because of this, they're now asking for help, and you're seeing a lot of fears, and you're seeing a lot of the bank stocks trading in negative territory. We saw the same situation in UK with the pension funds about to implode. Right? So Bank of England came out, was raising rates aggressively, saying, we're going to tackle inflation, to a point where pension funds started to have issues, especially with their LDI products. And I talk more about that in a video that I did. Just search up LDI, UK pension funds, and you'll find it. And I talk more about it there. But these pension funds who owned a lot of these assets, again, and they have to pay certain liabilities, they owe the pension, their clients, their pension, as rates started to go up and the value of their assets started to really crunch, it started to affect them, and they started to go to the Bank of England, and not only them, but the banks also in the UK were going up to the Bank of England saying, hey, if you don't stop raising rates aggressively, by 3 p.m. today, we're going to basically implode and default. So then that's when the Bank of England said, okay, let's come in and let's buy these UK gilts, their government bonds, to bring those yields down to safeguard the financial system, the banks, and the pension funds. So you're seeing the same thing here, but just with the regional banks, the smaller banks in the US, where you're having these implosions happen, and you're seeing the fear and the contagion effect spread to other regional banks as well, and also even the big banks where you're seeing sell-offs in the stock price. Now, will we see the same scenario in the big banks? Will they also have a problem with liquidity, with the bonds that they also have on their balance sheet? Because they do the same thing. They have a lot of these government U.S. Treasury bonds on their balance sheet, and they are also sitting at a loss, just like the regional banks, right? So are they also in trouble? Well, it depends on which bank you're looking at, but mostly, according to Powell, said there's nothing to worry about these bigger banks. And how these bigger banks usually protect themselves is they hedge against that interest rate going up through swaps. So if you're losing on one side through owning, and you have an unrealized loss on these government bonds because the prices are coming down and the rates are going up, you can hedge it with gains through your swap to offset the losses. So the bigger banks, that's why you're not seeing these massive drop on the bigger banks like JP Morgan. Actually, you might and you might be seeing some of them like JP Morgan trading in positive territory versus the regional banks because they're more well secured and protected. Until there's something that we find out maybe later on. Maybe there is, maybe there isn't. We'll find out later on. But what could that be, that thing that may affect the bigger banks as well and cause the economy to really drop like a rock? Well, one argument is, and I'm not a fortune teller and I don't have a crystal ball, so I could be definitely wrong here, but one argument that people have out there is that the real estate market. Now, we see the commercial property market in very in a tough time. You're seeing defaults, right? You're seeing a lot of commercial property owners trying to sell their properties because they're unable to pay the mortgage, the high mortgage payments, while no one's really renting their offices, right? You're seeing a lot of that pressure. And you also heard from Blackstone, BlackRock withdrawing, halting withdrawals and saying, no, you cannot withdraw your money because demand has completely crunched. Even in the residential sector, demand is completely crunched. There's no one buying. So it affected definitely, the commercial property market, especially with this COVID situation completely changing the way people work now. And you're seeing those defaults, and you do hear a big company like Blackstone, trillion-dollar gorilla, defaulting on one of its mortgage fund that they have. Now, it's a small fund, and they argue that, hey, all other funds that they have is secure and they're doing fine, so don't worry, this is a small little hiccup. Okay, sure, maybe not. But the point is, the cracks are there. The cracks are there, and you're starting to see the cracks in Blackstone, in the regional banks. And the next thing to look at is now the residential property market as well. How exposed are these banks, even the bigger banks, to not only commercial property? They may not be overly exposed on the commercial property side, which is why you're seeing these smaller regional banks maybe sell off more because they're more exposed to the commercial property side. And Powell told us that. There was a question during the testimony where someone asked, saying that, hey, are you worried about the commercial properties basically defaulting and the banks being overexposed? He said, for the big banks, I'm not worried, but for the small banks, we're keeping an eye on. So he did acknowledge and did understand that, hey, there is an issue, especially with the smaller banks. Big banks, I'm not too worried about. But what I'm worried about, me personally, is the residential side. And if that starts to show effects of weakening, and people are unable to refinance, purchase, or forced to sell, may not be exactly like 2008, but may have some effects in the markets and causing housing prices to drop. And housing market, real estate market, is a very big market. And definitely the banks are massively exposed to the real estate market. And if the real estate market is under pressure, whether it's US or Canada, what have you, then definitely that will seep in to the bigger banks, which may need help from the Federal Reserve of a bailout of some kind if it gets to that level. We don't know exactly. But definitely you can argue that yes, higher rates, higher mortgage rates is affecting everybody. And if the central bank continues to hike rates aggressively, if they do get to that 6% target, I mean, right now with all these regional banks and these fears and these cracks that are showing up, it could cause the central bank to basically step aside a little bit, see how this all goes and plays out. And we'll have to really see how, if they will continue on their path of higher rates. Now, expectation is that they could get to 5.5%, maybe a little higher. But now the expectation is that by the end of the year, there might be a rate cut. So we went from pricing in rate cuts at the end of the year to pricing it out to now pricing in at least one rate cut, 25 basis point rate cut by the end of the year. And it's all because of this fears that are developing. Now, my views are that this fear that's happening, and I think there will be some sort of bank or a little bit of a bailout for these smaller banks that comes out. I fear that when, if that happens and you do get some sort of little bailout package or these banks being bought up or liquidity injection, that everybody's going to forget about what's going on and the cracks that are showing month over month since last year, this year. I feel everyone's going to forget that. And especially with data, we've got consumer price index, inflation, etc., etc. If data continues or ends up to be a little bit on the weaker side, maybe this will be brushed off and equities will move up higher. The bond market will see, but equities will probably move up higher, completely ignoring it. And then eventually, if those cracks become bigger and something really breaks, then there will be a rude awakening for the equity markets. And we've seen that before in 2008. In 2008, we did see in 2005, 2006, leading to 2007 and 8, you did see cracks, you did see issues in liquidities in certain areas, but were completely brushed off. Housing market also, the fears there completely brushed off. Ben Bernanke completely telling people, don't worry, there's no problems at all, to then eventually leading to the great financial crisis and the big crash in 2007, 2008. And even when these big banks and these banks were in a lot of trouble and they started to cut rates, the stock market still sold off. And they sold off aggressively, even with the Fed coming in, intervening, and cutting rates, because there was just so much fear of what is going to happen, especially when you have the banking sector in complete trouble. So could we see something like that similar during, this year or next year? We'll have to see. We'll have to monitor the data. We'll have to monitor this real estate market, etc. We've got CPI, monitor the inflation. And most importantly, what's the Fed going to do? The central bank. Are they going to brush this off and continue to tighten aggressively? Could we see 6%? And what if the data of CPI, let's say, comes in stronger than expected? How are you going to fight inflation? You want to get to 2% target. And we know from history that to get to 2% target, you need some sort of crash. You need something to break in order for this inflation to drop. You need demand to completely crunch. You need the jobs number to be really, really bad. And then, you can get to your 2% target. But what that looks like is you would need a scenario of a hard landing. So are we going to get that hard landing? We'll see. It is going to be data dependent. It is going to be very interesting now with this new situation with the regional banks, how that will play out in the Fed's decision. And if they brush it off and say, hey, we need to fight this inflation, then it's not looking good for sure down the road. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.